Great. Well, thank you to both the speakers for some great presentations. Now we're going to have a short panel discussion. So I thought we'd kick things off today by maybe taking a bit of a step back and just thinking about tokenization and blockchain, and what do the panelists think that tokenization and blockchain can bring to the capital markets? How can it bring change? What can it bring? What can it bring? Make things operate differently? The benefits, I guess. And by the way, if the audience want to sort of, I'm happy for this to be interactive, so if anyone has any questions or wants to comment, please shout out. But maybe kick off with you, Graham.
Sure. So I guess from our point of view, we became interested in crypto in 2013, and then between 2013 and 2017, what we saw is suddenly a lot of projects come to market that were raising money through utility tokens, through these initial coin offerings. And whilst some of those projects, well, a lot of those projects ultimately didn't come to any value, it kind of brought about some interesting questions. Why are companies going to market? Why were they using tokens to raise money? How are they able to raise so much capital in such a short period of time? And for a large number of those projects, it was obviously because people were buying in at discounts and they were able to make money just turning rather than underpinning value. But what happened also was that you had new infrastructure players come to the market, so new exchanges, new advisors in the space, and it kind of enabled this globalization of being able to raise money. So you had a lot of SME companies who previously probably wouldn't have been able to go to an AIM, to a NEX, to a growth market and raise money, and instead they were able to go to an advisor and globally promote their offering and raise money in that way. And I think what we saw from that, please jump in, anyone else can address this, but what we saw from that was that a lot of those offerings, the reason they were able to do this is if they were securities, they weren't operating them in regulated fashion, and if they weren't securities, they probably didn't have any underpinning value to them anyway. And from 2017 to now, people have started to realise that, and they're now doing security offerings. And they're just really traditional securities, that's all they are. It's mainly equity debt in exactly the same way as usual, and the main underpinning difference is that instead of the registry being held in a traditional transfer agency or in a traditional database, instead it's held on a distributed ledger. And the advantages are numerous for small companies actually. So in London there are a number of issuance companies like Navora, for example, that will create your issuance for you, produce all your legal documentation and cut out a number of the costs that may be in existence if you'd have gone to the traditional markets. And not only that, but they're now able to more globally reach, more globally able to distribute these products as well. Whereas in the past, if you're on a growth market, you were probably only going to be marketed to domestic brokers.
Thanks. And what about Keith, over to you? I mean, you're kind of one of two on the panel who's almost like an end user of these things, or potentially. I mean, what's your view of what tokenization or blockchain might bring?
Yeah, from our perspective, really, it's quite simplistic. We're just looking for new strategies, new asset classes, and we've been looking at the space a long while. Connection with Archax is through Graham, who we worked with in hedge funds over the last 20 years. So for us, when we looked at it first, it was an absolute mess. We're looking at cryptocurrencies, fixed markets, utility coins weren't really of super interest to us. We were looking at, then we saw the futures market develop. So that's kind of where we're focusing at the moment. Obviously, when we see people like Graham coming into the market, moving from the institutional hedge fund market into crypto, then we get a bit more interested, and then we see the opportunity set with STO. For us, there's a lot of maturing to do, but things are starting to move quite fast, and where we'd probably look to see opportunities wouldn't be necessarily, let's say, in the securitization of small assets or slow assets like real estate, but rather, if we look at markets like, CLO market, CDS market, CMBS or MBS, these ones that are function reasonably well, but in a very kind of secretive way where it creates where a lot of the alpha is captured by banks themselves and that, so if those things were by blockchain, both in terms of the validation technology underlying, these assets, which are quite opaque, which eventually caused, 2008, if that could fix that, that would be one part of the mix, but the other part of the mix for us would be that, more alpha would be flooded into the market, so that's where we see the opportunity set for this.
Okay, thanks. And Campbell, maybe over to you, because you're, again, almost like an end user or potential of some of these things. What do you see the benefits or potential benefits as?
Well, with regard to tokenization, I'm not a great expert, to be honest. I only talk from the perspective of market infrastructure. With regard to tokenization, I'm sure that would benefit a lot from the institutionalization of the way the market works. The word institutionalization is very overused and misused. I would prefer to use wholesale, real, where buyers and sellers meet. I assume, I don't really know anything about tokenization, to be honest. I'm from an exchange background, but from a market infrastructure point of view, having a tokenized world where people can exchange risk in a safe, transparent environment is good for everyone, including the end user.
Right. And Rebecca, what about, I mean, you put blockchain in your description of what your role is. So, I mean, how do you see, you know, in the work you're doing, I mean, what do you see as the kind of the interesting paths that blockchain could move down in terms of the capital market space?
Well, actually, I don't have anything to add upon what's been said right now. I just want to add maybe a personal point of view as far as my kids are 16 years old and they've just opened a bank account.
I don't think it's working actually.
It's just a prop.
It's a prop.
Yeah, have this one, have this one, have that one. I'll shout, don't worry.
It is a new asset class, as mentioned, and it entails a lot of opportunity, I would say, for institutional investors, etc. But my kids are 16 years old, and I'm working in blockchain, seeing institutional customers all around the world, but in APAC mainly, in the US, and here in EMEA and London specifically within. But my kids, as an example, just opened a bank account, and they did not even consider going into a regular bank. It was kind of banished. They just went onto the digital bank in Israel. And for them, I don't think that blockchain would be banned in any way. They would consider it like a first option, not a second one, and certainly not a banned one.
Simon, if I can just move on from that point, because it's an interesting one, and one that Professor Lindell brought up earlier as well, is the financial services kind of works, but it's really slow. And even though it works, you kind of take it for granted, but only when cryptography and cryptocurrencies come along do you realise the speed that it can achieve. But the problem is, if it isn't throughout the whole value chain, then it's always limited by the bottleneck. So to the point earlier about custody, if it's slow, then you can't perform transactions at the speed you need to be able to. The reason that we're opting for an omnibus account on our exchange rather than having segregated blockchain wallets, which would be perfect, is because at the moment it just can't achieve the speed that's necessary. And if you're moving the whole world towards this new financial infrastructure, and then everything needs to be built on these new rails. So it's important that the custody, the clearinghouses, the exchanges and settlement are all built on the same, and the issuances themselves as well. So the issuances, by being on blockchain, are able to transfer ownership quickly. If you have the currency itself built on a blockchain as well, that's able to transfer quickly. And you need all of these pieces in place to really achieve the kind of full vision of disruption financial services.
Good, thank you. And obviously that's kind of interesting about some of the opportunities that blockchain and tokenization bring, but are there any other, and you've touched on some of this already, but are there any worries about the problems that may come with it? I mean, obviously crypto has a bad reputation in terms of, you know, thefts of keys and thefts of Bitcoin from exchanges and stuff. You know, with an institutional hat on, what do you think people will worry about?
Well, I know Keith's got a lot of views on this area, or at least he better start thinking of something now because he's getting a mic in a minute. On the crypto side, you know, everything that we heard from Unbound earlier is all relevant to cryptocurrencies and to digital securities as well. And with cryptocurrencies, they are bearer assets, and it really does mean if someone hacks and takes it, the chances of you getting back are pretty slim. Now, there are a couple of instances where people have trace the transactions through the blockchain. Recently there was a case where there's a fund called Alphabet in the UK. They had 100 Bitcoins stolen. They were able to freeze 80 of those Bitcoins at Coinbase and get them back. But really you're taking such a risk for that happening because once they're transferred there really are no control mechanisms. On the digital security side there's an underlying registrar. We can, whilst as Andy was saying earlier, we need to build the custodian within all of these onion layers. Ultimately we've got a couple of backstops. You can't transfer securities to people that aren't on the whitelist, and there's an underlying share registrar, so you're protected as well. But you need to perform all of the checks on every piece of the infrastructure you would in the traditional world. So for example, Andy talked about the crypto custodians that we spoke to, and in so many instances they said they were able to do one thing, and when we said, okay, we want a fully deployed solution that we're in complete control of, it would always be the case that someone at the custodian was able to completely change our user rights, which is a huge problem. It pretty much negates every single control we have in place. So just really asking all of the right questions as you would from any due diligence makes a big difference.
I suppose really I'm looking at it from a hedge fund professional's point of view. We're just culturally used to, when we're making an investment decision, custody really is an important part of everything that we invest in, be it equity, bonds, or whatever. But it's never really been a kind of a core concern for ourselves. So for us, really, in terms of let's say validating assets, we're reaching out to prime brokers and they're telling us what the assets are and what the relationship is, and kind of fairly basic qualitative data points for us. But it's never been the case that I've gone to Morgan Stanley and said, can you give me your sub-custodian agreement and tell me who your sub-custodians are and tell me how that omnibus reconciles every day. It's just assumed that works, and it has worked since DTCC was created in whenever it's 60s or 70s, and all of that works. Culturally, so for us to jump to the crypto side, and it's been problematic for us, when we've looked at crypto funds, is that, this custody thing, which was one of the table legs that we based our decision on, now is gone, and it's a huge issue for us, and for us who are, kind of, let's say, more flexible of mind and more punchy in terms of what we can do, and I would say in terms of our level of sophistication of the people that I work with, if we don't have necessarily the capacity to pull the trigger, then, especially if we're looking at bigger investors like, say, ERISA type investors who have, very strict rules on these things, it's never going to develop as a market, so the custody element, which is normalized in everything else we invest in, if we're ever really going to develop out a crypto theme within our own product development, the custody part just has to be nailed down.
Okay, and I don't think it's just work, does it? Rebecca, from your side, in your work, you must kind of talk, know what do institutions get worried about with blockchain coming? What is it that worries them, do you find?
Well, besides the key, of course, that we've talked about so much, we have now a very large POC in the United States with a very large customer. And it is interesting to see how that customer is very much busy with defining policies that would be relevant for custodians, for institutional customers. So they must have offline participants, as you mentioned, to be able to ensure the custody money. They must have segregation of duties to be able to adhere to the local regulations. And all of these can be supported with risk-based policies that we use with MPC. But I don't think that people very much appreciate how much the key is sensitive and how much work has to be put in to define those risk-based policies, to defend those no rollbacks type of blockchain transactions.
Thank you. I thought maybe we would try to involve the audience a little bit here, but maybe a show of hands first. Is anyone here actually actively involved in crypto trading or digital asset trading? So a few. And anyone looking at it? No, not involved yet, but looking at it. Okay, interesting. And in terms of covering some of what we've talked about already in terms of blockchain and tokenization, anyone here have an opinion about what they think might be a real benefit from your experience, or something that's a real challenge, or something to really worry about?
Sort of a scam, really, isn't it? Tokenization. The ICO sort of debacle was effectively a sort of big disaster for investors, and really it shouldn't be allowed to happen, but it was actually. How do we actually turn it into a legitimate business, and how do we trade these tokens?
Well, and I think STOs are part of the answer to that, but maybe I'll let Graham, because I know he's well versed in an answer to that question.
Thanks. Payback right there. So I guess I guess there are some good use cases for companies raising money through utility tokens, which were done through the ICOs. But you're right, for the most part, ultimately, I think so. I think I saw today that they're at their lowest they've ever been, and it's unlikely to be an all-season bounce. And the reason for that, I think, is that most people that were investing in these things were pure speculation. There aren't many people that were thinking, this is a great idea, I want space on that server in 10 years' time, and I'm going to buy a voucher for it now. Most of them are thinking, okay, I'm getting in at a 40% discount, so I can sell this at a huge profit tomorrow. And it's not really a Ponzi scheme, but most people were speculating on what is the next person going to buy. And the problem is, when all was said and done and the market calmed down, people were looking at what they bought and thought, oh God, all I've really got is a voucher for a shop that's not yet built. And the company I did no due diligence on, they didn't hedge the money, they've lost the money themselves, or they've flown off into the sunset with their riches. So really, you know, it was a huge issue, and I don't think that issue is going to be corrected because the FCA has come out and said utility tokens are just not in our remit. But for securities, it's totally different. For securities, they're fully regulated. You are as protected as you would be in the traditional world. In theory, even more so because of the technology. So I think it does change when it's a regulated security. And all that's really being done here is that you're just buying shares in a company, and it's the same way you would usually. But that share register, rather than being an Excel spreadsheet, rather than being an Access database, is just an immutable distributed ledger.
I sincerely hope you don't actually deal with systems that use Access, which is a single-use database. The moot point is basically that you've got banks which have levels of fraud and levels of loss, and basically there's a whole lot of issues with post-transaction sort of like adjustments that happen within our banks, as we all know. It's kept quiet, people don't talk about it. What digital basic sort of wallets and distributed ledger gives us is a de facto record of what actually happened. And I think that's the fundamental thing that banks are really worried about. It gives an immutable register of what's actually going on.
Yeah, you're absolutely right, and we think at Archax the biggest use case for this is actually post-trade and back office. And I've spent most of my career in operations. What that really means is I've spent most of my career reconciling accounting systems, and the reason being is no one in that trading infrastructure trusts each other. So you've got an investment manager, an administrator, a prime broker, a broker. You're all pre-trade matching, you're confirming, you've got morning reconciliations, and that happens all the time. And
So can I translate into normal parlance? Isn't that like cooking books? To make sure that things actually sort of like balance?
well, no one really cooks the books because ultimately they all need to reconcile for an NAV. But what happens for some reason, inexplicably in the middle, is everyone ends up with different numbers, despite the fact there was one transaction with one quantity, one price, one consideration. And people have different commissions built into their system, which are fixed, which generate the wrong numbers. People assume the wrong split of transactions between managed accounts, which causes problems. If you have it on a blockchain and you've got two investment managers coming together on a market, then there's immutable proof of that exact transaction. And using something like a permission blockchain, you can open up the permission to that to all of the counterparties involved. So no one no longer has to run their independent accounting system, because part of the use case of blockchain is that it is trustless.
But isn't that basically what the regulators are actually asking for?
I think
Accountability, which is not what some of the banks are used to at all.
Yeah, I think the regulators are trying to work out exactly how it works, and it can't really work until it's embraced by the whole ecosystem. So you're right in that it needs to be embraced by everyone involved in a transaction, and they probably all need to run their own independent nodes for it to be truly decentralized. But ultimately, if you get the regulator to the point, let's say on Archax, let's say we build our back end on a blockchain, then what we intend to do is any of the hedge funds which trade digital securities on our blockchain, they'll have a representation of every single trade that comes out of our back office. It will be exactly the same as ours. What we want to do is open it up to their prime broker, to their depository, to their administrator. And when they come to reconciling their NAV on month end, everyone should have exactly the same transaction. And not only that, but if we give the regulator view to every one of the participants on our venue, then they should have all the transaction reporting that they currently get as well.
Well, we're getting close to 8 o'clock, and I promised we'd be done by then. But one last question, and then we'll open it up if anyone has any other questions. But what do the panel think, and maybe starting with you, Keith, if looking into your crystal ball, where do you think we'll be in 5 years' time with all that's coming down, the technology that's emerging and tokenization, blockchain, everything else? Any view of how you see the world emerging in sort of 3, 4, 5 years' time?
I suppose I'd put it in context of what it was like 2 years ago, and the amount of jokers that we saw in this space, and now 2 years after, we've got a lot of institutional guys. The one thing I've noticed is things have gotten more quiet, and I like that. A lot of the stupid talk is gone, and now we're kind of getting into normal business. And I'm just seeing patterns of behaviour around happening, and it's all very positive, and I would say we're accelerating, and what that is too, I'm really focusing on quite a narrow perspective. I want to invest in hedge funds that do something and get me alpha, and alpha's quite a difficult thing to find these days, and if I can find crypto funds that are either, doing something on the quant basis, maybe on futures or Bitcoin or some utility coins or whatever, that's fine. But also then the STO thing is probably, you know, I'm a believer conceptually in it, you know, but whether it'll actually find the liquidity on the other side in the short term, God knows, you know, but if it does, that creates a huge alpha opportunity for people like us.
Okay, Rebecca, what about from your view?
Well, just reflecting on what Unbound is saying, we're seeing customers around the world sort of imitating the old world, and it's actually good for the business because it means we're using self-regulations, we're adhering to regulations of the old banking world, which will bring, I would say, the more institutional investors in. We're seeing maturation of use cases. We're seeing customers from the old world starting to embrace blockchain use cases wherever they see, I would say, a group of organizations have to cooperate. So it's not blockchain everywhere, it's blockchain for specific use cases. We see customers paying money for blockchain-based security solutions. That's always a good sign. So the market is moving ahead, and I would agree with you, Keith, that I like very much the fact that the rubbish, I would say, investors are getting out of the picture, because this means that the serious ones are in, and the market is moving on, I would say.
Thank you, and Graham?
I guess split it into crypto and securities. On the crypto side, I think you know, a lot of the jokers have gone, a lot of the people raising money through ICOs have gone, and the ones that are raising money through utility tokens are probably much more likely to be utility tokens, so with an actual use case. And we were at Blockchain Live today. It was pretty much absent of anyone raising money in that fashion, whereas for the last couple of years it's been free swords and key rings all the way around. And then I think you know what we're seeing,
isn't it?
but I think in the yeah, my kids hating it. In the crypto space, you're starting to see more institutional players. So what the FCA have defined as exchange tokens, which really methods of currency or exchange of value. You've seen some things there which seem to be sustained, and you're seeing more institutional exchanges pop up in that area which are more credible. So GC Exchange and LMAX, they're both here. They're in London. They're institutional. They're regulated, and it adds real credibility to the area. And what that does is it means institutions can come into the space and start deploying capital. And Backed was launched just a couple of days ago, and it started with thin volume, and that's picking up as well. So I think institutions realise that there's something happening in crypto. No one's quite sure where it's going to go, but something will happen. On the securities front, I mean 5 years is an awkward timeline because I always say 10, but I think in 10 years everything will be issued on the blockchain, and not because I'm a big believer in blockchain, just because it's a more sensible technology for everyone to issue on. In 5 years' time, I think we probably would have got through this large volume of property and tokenization funds that we're seeing right now, and start to see more listed products move onto the blockchain. And I think you'll start seeing more institutions move into the space. So we've already got LSE investing in Novora, 6 out of Switzerland are moving into the space. Only yesterday, Securitize, which is an issuance platform out of the US, raised money from Santander, from Nomura. Those guys wouldn't be investing in the space if they didn't think digital securities was a part of the future.
Thanks, yeah. And Campbell, a 5-year view from you?
Yeah, I agree with Rivi with regard to the hot money's leaving the system, which is good. The atmosphere at Blockchain Live today was very different from last year. There was Lamborghinis and teenagers drinking cocktails, etc. But I think you either believe that digital is going to be the future or not. It's a very binary thing, so I, for one, certainly do believe that that's going to be the case. And it will enable what I would consider the nirvana for me personally as an evangelical market person, that we can have a world where we have all-to-all markets. So anybody who wants to transact can transact with somebody who wants to transact rather than going through an intermediary. This is what the whole blockchain, the whole crypto world is all about, enabling decentralization and having end-to-end trading with each other. And that's kind of where I would like to see, and I believe and hope that that's where we're going to be 5 years' time. Maybe 10.
Thank you very much, yeah. You're obviously welcome to corner the panelists or the speakers over drinks, but has anyone got any questions now? Or you're all too hungry and thirsty? Okay, well, thank you very much for attending. There's some, thanks to the panel.
Cheers, guys.
Thank you.